All right, guys, welcome to a recording here of Ask a Trader. Should be about anywhere from 35 to 45 minutes long. And I'm just going to do normal stuff. I'm going to go over the markets. Now, this is going to be the first time that I've actually looked at the markets probably within the last couple of weeks because I find that when I personally track the market, whether the market's long or short, it actually kind of distracts me from what I'm supposed to be doing, which is trading low float volatility. So I'm going to go over the markets. I'm going to go over some of the sectors that are showing some strength. We are in the middle of earnings season right now, as in just started mid last week. Banks, I think, are still going and reporting. We had some stuff on Netflix today. Horrible numbers. Declined substantially. And not going to go over that. And then I'm going to dive into what I was trading today and how I traded it. Then I'm going to go over some of the other opportunities and the technical opportunities that were shown. And then I have a couple questions here that I'm going to go over. One is trading first pullbacks after a breakout. I'm going to go over to that. And then maybe looking at different types of pullbacks and breakouts, and then also looking at longer term expanding triangles and patterns, generally speaking, on an intraday time frame. So those are going to be the things I'm going to cover tonight in Ask a Trader. And if I've missed anything, or if anything I have said doesn't make any ounce of sense, you all know how to get a hold of me. I can be DM'd through chat, or you could buzz me out in the opening chat, email me, call me, whatever. It's all good. I'm going to start off with the markets. S&P in the top left-hand corner, it's the SPY, and you can see that we have been range-bound for a little while. What are we looking at? About 460 over 413. I think these lows are about 15% off of the highs, 14% off of the highs, and we've just been consolidating in this range. This is choppy. February, March, very tough time. You'll also notice that this is around the time where the war started in the Ukraine, and so the market, excuse me, the market hasn't really been. It's directionless at the moment, is what I'm trying to say. It's just stuck in consolidation. If you look at the pattern, though, there is an inverse head and shoulders pattern. You'll see that there's some past support and now some double top resistance. If this level of 460 was to pop long, price action could potentially run to the upside. Now, having said that, if it failed at 460 and started to move lower, and then we got a little bit of a bounce, that would actually continue, or pardon me, complete the right shoulder of a potential head and shoulders pattern, which would be trading below the 200-day simple moving average, which would prime this thing for an epic breakdown. To what levels, I'm not entirely sure. I could only speculate that, let's see, we're about 10 points off of the neck to neck line, or the head to neck line. So if we went down another 10 points using the measured move, that would bring us into a key level of about 368. 368 from the top of the market down to 368 would take us into about 23% low off of the highs. Is that out of the question? Not at all. Is it out of the question that this could actually be a flag and price action breaks long at 460 and goes back up to all-time highs at 478? Is that viable? Of course it is. The big thing to remember with the markets is that anything's viable. That's the thing. It's not about the validity of what could potentially happen. Just assume that something mental is going to happen. And so once you gravitate towards the idea that you and I can't control anything in the markets other than the spots that we pick to capitalize on those things that are happening, life as a trader becomes a lot easier, right? So I don't know that there's any value trying to figure out what's going to happen. The only thing that we should constantly try to figure out is there more reward versus risk on this pattern that I'm about to trade? Is this pattern part of my arsenal of high probability situations? And is this stock that I'm looking at liquid enough, long short, to capitalize on that reward versus risk? And is there enough volatility in this play that I'm looking at that could take me to that reward situation? Okay, those are the really only questions you should be asking. And that is how you apply your personal edge on the market. So I don't know what's going to happen with the SPY. I seldomly these days watch the S&P 500 when I'm trading. I try to focus on the volatility that's hitting my chart only, and literally zero shit's given about anything else that's going on in the market. If we look at the IWM, which is the market that, well, the R2K, Russell 2000, small caps. This is generally a bit of a leader in the sense that this is a big risk on trade, as you guys know. So when capital is flowing into the market, it usually hits the IWM first, into the Qs, SPY, and then to the diamonds. The diamonds are Dow 30, super stable companies, and it's a very, very safe place to be. When capital flows into the IWM, that can potentially indicate that traders are bullish. Now you'll actually see that there's a floor right through here, which is acting as a ceiling now at 208, and 208 is over 191. If that level breaks to the downside, we could see some real troubles with the IWM. IWM, also the small caps, generally speaking, are more or less in a bear market. Okay, it's 20% off the top, and if you actually look at what's going on here, this is a bear flag in a bear market, and this is arguably the best time to be trading to the short side this particular market. You're below the 200, it's a bear flag, you're in a bear market technically from top to bottom, and this is not looking healthy. You'll also see that there is some relatively decent movement to the downside on the MACD, meaning that the momentum is geared towards the downside. So when this crosses over and then crosses back down to the downside, it's signaling that the momentum is on the sell side of the market. When you're on the sell side of the market, below the 200-day simple moving average, and the entire market is building out a 4-month-long bear flag, I mean, shit, son. What do you think is going to happen? The probabilities are suggesting that this thing is due for an epic drop, right? So, I mean, if we were just to say use a measured move and it broke down, let's see if it intersects with the key level. Look at that. It always does. I mean, spoiler alert. Look, right? So you've got a whole floor here. You got a bear trap there. You got a floor here. You got support that turns into resistance, and then it breaks out, retests, and rallies. And this measured move down to 142 is perfect. It's perfectly in line with a past level of significance, IWM. Okay? I don't know that we need to go over the Qs. More or less the same thing. And the diamonds, more or less the same thing. You see, though, that there's a little bit more bullish volume stepping into the market here versus the IWM, the SPY, and the bearish volume that's hitting the Q tape. Essentially what we're getting information-wise here is that people are moving in. They're cycling out of riskier assets and equities, and they're looking at things that are maybe a little bit more stable. And investors, I should say, could be gearing up for a capitulation in the market, which could drive price action to the downside, and some of the Dow 30 stocks, as solid as they are, now become great investment thesis. There's a great investment thesis there. So you see that the volume is stepping up, so investors could be stepping into this, okay? And the more investors that are going to step in, there is going to be some short-term volatility, and with that short-term volatility, you're also going to get short-term intraday traders coming in, and that could also increase and perpetuate the volatility that we're seeing on the diamonds. Now, I'm not saying it's crazy volatile. It was only up 0.9% today, but there is above average volume that's hitting the tape. I would suspect that people are looking for some security right now. So that's the market, overall markets. If you're looking at the Qs, you know, we have this big head and shoulders pattern with 147 support. I've got the measured move out suggesting that it could come down to 119. If it did come down to 119, that's 32% off of its high. And you can see that there is some movement in that area back in 2020. And so that could be a floor. If it went past there, then I have no idea. You'll see that the consumer staples were up. And this is more of what I refer to as a defensive play. You can see that it's moving up while a lot of things were moving down or were up only roughly a percentage point. We also have healthcare that's up quite a bit. And what I'm seeing here is that people are running to more inelastic type securities. Inelastic meaning that the companies that you and I buy things from that we need, not necessarily want, but things that we need, household items, toothbrushes, toothpaste, deodorant, things of value that we absolutely need, that we will still buy no matter what's going on in the market. Those types of inelastic stocks and companies and products reside in the XLP. So there's no, it's no surprise that this thing has stepped up off of its 20-day as vigorously as it has, because a lot of people might be running again to defensive-based stocks. I was having a conversation with a friend of mine today, and we were talking about the difference between owning Apple in a recession and owning Colgate in a recession. In a recession, there aren't going to be, especially if that recession reverberates not only through the United States and Canada, North America, but if that also hits, big parts of Europe, like Germany, for example, if China got rocked economically, for example, who the hell is buying $1,100, $1,200, $1,300 cell phones? Who's buying $500 and $600 digital watches when markets are in a shit position? Not a lot of people. So with that lack of demand, the price action for the underlying stock, Apple in this case, is going to be a little bit depressed, and it's going to be moving to lower levels. Having said that, I still, no matter what, if I decide today that I'm not going to buy an $1,100 cell phone, I still have to go and buy deodorant and toothpaste. Like, that's just a fact, okay? So the fact is, in this situation, going to Colgate, for example, might not be the sexiest trade, but it might be that thing that does get investors and long-term traders through a rut in the market, okay? And owning the sexy trade might be, this might be a decent time to get out, or to adjust stops, or to maybe even start hedging with options if that's your thing. If you hold a core position and you're long and markets are coming off, then buying some put options against it to hedge losses and hedge the way down. Just an idea, not going to get into it, just a thought. This might be a time, though, for investors to move out of tech and move into more consumer staple type inelastic trades, if that makes sense. If it doesn't, email me, text me, call me, whatever. I'll walk you through that one. Day trading. So today we're going to talk about ALVR. I'm going to go over here, ALVR. I'm going to blow this up on a larger chart, and I'm going to go through this particular play that I was in. And again, I walked you guys through this one, and I actually really like doing this because there's something to be said about me posting in chat after the market closes that, oh, hey, look what I did. I executed a trade on this. This is where I was in. This is where I was out. This is what I got. Like, that doesn't tell you much. So when these things occur and I have an opportunity to look at a tradable situation, I really actually like putting this in chat for you guys in the newsroom, because what this allows you to do is it allows you to get into my my headspace in real time, and you're seeing over and over and over again exactly how I'm executing on these opportunities, and just how shitty these stocks are, and just how important using a profit target taking tool is, and what hardcore scalping is really about. So you can see that I talked about ALVR pre-market, and I was talking about a VWAP squeeze. I was talking about the significance of these topping tails and how those could potentially be problematic, and how that reeks of a supply issue and a lack of demand issue. And those are things that we got to watch out for. And I was saying that before the market even opened. I was saying these are things that I'm concerned about. Topping tails, that's a lack of demand story right there. It's telling the trader to watch out. This thing evidently moved to the downside pretty hard. This was up a lot earlier when we were trading it. But what was I doing? I was looking at a VWAP squeeze, and I was looking at this area right through here. And this thing popped into the market. I was on a 2-minute chart, and this is exactly how I was looking at it, right? So I was looking at this candle, it set a high. I was looking at this candle. I was looking at this candle. I was looking at this candle. And then all of a sudden I'm in. I think I was in at, I want to say I was in around 7. It was a little bit late, 7:20-ish. Because I got in, I was triggered in, and then all of a sudden I was up 60 cents. And this thing was in a halt. And I was like, okay, sorry. What the fuck just happened there? Like, it happened very, very quickly. Got into the halt. This thing moved up higher. When it was in the halt, I was mentioning in chat that, okay, I'm going to start to get aggressive with my stops. One thing that is becoming increasingly important for me is to, and there's so many reasons, well, there's two that I can think of, two reasons why this is important to do this. But when I'm in a trade and it immediately moves in my favor, the first thing I want to do is I want to mitigate any risk, and I want to change the reward to risk factor, okay? So in this case, you'll see that we've got 816 over 711. That's my profit, potential profit. And my potential risk is, let's just say 711 over 685, which is about what it was. I think it's a 4x trade in the sense that I had 4 times the upside versus the downside. So that's where the reward to risk ratio starts. It starts with a 4-to-1, 4 times the upside versus downside. That's where it starts. But the second that the trade starts to work out for me, I immediately start adjusting my risk, and you guys might be keying into this. You can go into chat and look at this, but I'm immediately mitigating risk, and I'm moving from risk threshold to break even. Because now it's just, okay, I'm either going to hit target or I'm going to just forfeit. And when I say break even, I mean I'm taking in commissions into account as well. So I'm either going to be hit and I'm out flat, nothing, net flat, or I'm going to hit target. And as soon as that thing moves and then it keeps moving and then pulls back and then confirms another leg up, that's where I start to adjust my break even to crystallizing positions on the chart. And in some cases, when price action really steps off of the VWAP or the EMA, I just get aggressive and I put both of my hands on the throat of this stock and I choke it, right? So I more or less want to get out, and I just want to be able to crystallize what I've got. Because the thing is, if you're trading a good chunk of size, 10 cents matters. And the difference between 15-cent gain and a 10-cent gain could be, in some cases, a couple $100. In some cases, it could be a few $1,000s. So it's really important that once you start to get into a decent position and it's working, I don't know that a trader should feel, I most certainly don't feel guilty about choking the trade off, because I understand the makeup of this trade, and it's volatile. And the volatility lasts for a very, very short period of time. And the volatility that we can experience on the upside can turn on a dime and absolutely dump. And so, again, looking at this from the perspective of risk management, I'm more concerned about the potential that this thing could reverse against me and collapse. And that's why when I'm up enough, I really start to hammer in on reducing risk, and I will actually reduce my risk to a point where I'm giving the market little to no room, and it actually takes me out, and I'm totally fine with that. Because when you start to nickel and dime the market like that, and you start to stockpile those gains over a week, over 2 weeks, over a month, over 3 months, over a quarter, over an annualized period, that adds up. It really, really adds up. And it adds up fast. And if you're using an asset allocation model, it also compounds very quickly. Because remember, if you go into a trade and you're using 20% of your capital, and you have a bunch of trades that work out for you, and now all of a sudden your account is up 50%, and you're still using that 20% allocation model, you're using it on the account plus 50%. I hope that makes sense. But you're naturally scaling. So the more money that you bring into your account, you're naturally scaling by using that same allocation model. And it compounds and compounds and compounds, and it scales. And then you just turn a corner where it's ridiculous and you're just making a shit ton of money and it's compounding. One of our traders, she did this successfully. Her account is up 300%, I think she mentioned in chat a couple weeks ago. And she killed it just by doing that. Asset allocation model, I believe she used, and then it was just compounding small gains, but they all add up. And here's the thing. When you go after small gains, you will be given a big one. And again, if you're using that allocation model, and I'll switch gears after this, but if you're using an allocation model and you've just had that trade, that intraday unicorn trade where you're up 50, 60, 70% on the position on the day, when you take that back and you reallocate everything out, you scaled in a big way. Super important. So ALVR, I had no problems choking this trade off. I wanted actually to get out. And the thing about the way that I look at trading is very simple. And that is when I see a nice high probability pattern, I want in. But the second that I get in and the volatility is starting to work for me, I really, really want to get out. So I diligently try and practice my profit target taking levels. In a lot of cases they're hit, but if I'm in a position like this bar right through here, if this, connected and we had another massive bar like that, and it's getting really extended off the moving average, I know that more often than not, well, it's almost guaranteed, hate to use the word, but stock always reverts back to its mean. So you can see right through here, this is the first bar. This took off. It was a rock star, and it totally lifted off the VWAP. What did it do? It reached a point where there was nothing left. What did it do from there? It reverted straight back to the VWAP. Sold off, rallied into the VWAP, sold off again. Reversion to a mean. That's why I always say that when you start to trade these positions, you generally want to get into a situation where price action is in its infancy stages. And what that means is it's close to the moving average that you're using. It's close to the VWAP. And you want to be trading a high probability situation where the reward is greater than the risk. And all of these things have to be in your crosshair before price action steps off of the EMA, SMA, VWAP, whatever you're using. Because it starts to hit a level of maturity. You see these pockets of air that it catches? Once you start to see those, and they're not closing up like this, they're a little bit unnatural. And what happens to these unnatural bubbles? They pop. Boom. Reversion. Okay? Hope that made sense. I'm going to go back to our day trading scan here. I'm going to show you that we had a number of really great opportunities. And maybe what we'll do is we'll look at the 2-minute chart here. And we will go over where and how these tradable opportunities look. And I think this is probably a relatively decent chart to go into and talk about. I'm going to go to the questions here. Hi, Julian. For AAT, sometimes you trade the first pullback after a breakout. Maybe talk about the key differences to look for between what might be a pullback and what might be a reversal. Awesome. Okay, so let's go and look at this space right through here. So there are some key components to this very chart that I can appreciate. And the first one is, this is a breakout candle later in the day, right through here. Try to make this up here. So that's a breakout candle. Price action puts in a high, and then it starts to pare back a little bit. Now, when I see something like this, okay, and I'm going to really zoom this in. There. So when I'm looking at this, there are a couple key components that I'm looking at. First of all, the breakout candle is huge. This is what's referred to as a master candle, meaning when the range high breaks out, you want to get long the stock. Okay? And the reason being is that before the breakout, you're seeing this real body. It put in a low, but it closed up here. So this is where it opened. It came all the way down, and then the bar closed right through here. But it's got this bottoming tail, saying that there is a demand story there. Okay? And we get that again here. And what else? The other components that we're getting is that the lows are getting higher and higher and higher, and that is an ascending triangle. And at the apex, it has to squeeze. And there's that squeeze at the apex, which is more or less the most finite point of that stock or of that pattern. So that's the breakout candle. There's the first pullback, and you can see that it set this ceiling in. So I'm going to go through this again. The high right now, it's a double top high of 217. The way that we look at this is, yes, it's pairing back, but yes, it's holding its moving averages and the VWAP. So that's positive. And the second that it gets up above that 217 level, we want to get long that stock. And that's how you trade the first pullback. You make a note of that first major candle. It also could be 2 or 3 of these candles, and then it pulls back and does the exact same thing, and you would approach it the same way, looking for the same things, the VWAP, moving averages, etc. But that is the way that you want to do that, right? So you look at the initial move. In this case, it was one massive bar, and there was decent size to it. I mean, this is a 8% bar, and then we get that pullback, and then we traded that breakout high of 217, and then the trade happens long from there. Now, on the flip side, if price action put in this low and bounced back up, we consolidated because that's what these 3 bars are. This is consolidation. Why? Because it's within this candle. So this candle has set the range. These have not breached either the long or the short side of that range. So that is consolidation. And consolidation breaks out right through here. Okay, so we know that. This master candle has a range high of 217 and 199. Consolidation, consolidation, consolidation. Now in this case, again, we were given a breakout opportunity, so we went long the stock. Now the other side of the equation is that price action could have come down a little bit, and could have come down a little bit more, like so. And this is what we would refer to as a, I'm going to try and see if I can, how did I do this before? Edit? You know what? Who cares? Imagine these are red bars. This is what would be a technical reversal, because that is the master candle, and we've got the range high, 217, range low, 199. Okay, so you got an 18-cent spread, and if it gets broken out to the upside, you get long. But if price action was to do this and sort of hit this ceiling, find some resistance, and then start to move to the downside, and then you get that one price action bar that breaks the low of that candle, that would signify a technical reversal. So you can see that up until that point, everything was relatively bullish. Let me see if I can, everything was relatively bullish, but if you got those bars moving to the downside, that would be a trigger to get short the stock or to not trade it at all. Now in this case, you can see that the range actually broke long. Okay, so price action pumps, it pulls back, you get a nice flag, then price action moves up, pulls back. If you miss this, if you miss that flag, you would look at this pullback again. So there's 2 things here. Some traders are going to wait for confirmation, they'll take the second leg up. Nothing wrong with that. If that's your edge and it produces a high probability set of trades for you, fantastic. I support that. Not for me, but for you, awesome. The thing is that if you were to have missed this and you're looking at the stock here and you're like, oh shit, I just missed the breakout. If you arbitrarily jump in, you're chasing. And if you arbitrarily chase a stock, you deserve to get your hand slapped for it. As do I. I do not condone chasing price action. Okay? We're not in the second grade. We're not chasing our first crush around the park. You know what I'm saying? This is different. Wait for price action to come back. You'll see that this pattern right through here is identical to this one. And this pattern, being identical to this one, is in the same state that this pattern that broke out is in. It's above the EMA, it's above the VWAP, it's above the 200. So theoretically, If that range high at this point, 225, was to break long, then I'd want to get into the trade. And what does it do? It breaks long. So let's say you missed that one. I think you know where I'm going with this. There's two ways you could do this. But this thing, let's go down to the VWAP. It steps off of the VWAP, which is also a technical retest. It pushes, pushes, pushes. And then on this bar, you can see that the volume steps in. That's where we get long, 239. And then from here, it pushes. And at this point, I always do sort of a three count. And this is why I really like to get into the first trade as often as possible, because that first trade is where if the market and high frequency traders really step in, that's where the biggest rip is going to be. And if you're on board for that ride and you're ballsy enough to get in on that portion of the move, and the general participation arena is watching that, they're going to get in on the second move. So you're already in place to take advantage of the first move and the second move. I hope that makes sense, which means you can really extrapolate your gains. Okay? But there's generally three moves, and this is where I was going. I damn near forgot. But you can see it moves up once, moves up twice, moves up 3 times, and then it starts to lose a little bit of its potential into the close. Okay? So I really like to get in on the first move, and so I'm on board and positioned for the second move. That's what I prefer. We're going to go over to DubBev. Okay? We're looking at the same situation here. So price action starts right down through here, puts in that first candle, pulls back, moves back up to that level, pulls back. So that tells me that this area right through here is significant. But when I see this topping tail, this also tells me that the market's not ready. It's not there. There are no orders lined up on the other side of this ceiling. Tried it once, tried it 3 times here. Well, 1, 2, 3 in total. And then tried again, tried again, tried again, and then finally stepped in. Point is that when it actually stepped up, it was taking out that pre-market or that those highs, and you can see that the overall pattern, and this lends to the idea of the question that I was asked about larger patterns. This is a relatively decent play. Now, I'm going to be completely honest. I would probably be looking at this level because I'm a big fan of the VWAP squeeze. And you can actually see that by getting in here at 395, you can ride this up to 416. Now, if the market started to press a little bit and it came off, you would already be positioned in profit, if not break even at a bare minimum. And you could sort of see the river on the flop here to see what happens with this play. But you can see that VWAP squeeze comes alive right through here on volume, and it pushed long. Same setup. And this is a larger ascending triangle pattern that played itself out over a 4-hour period, intraday, 2-minute chart. So there is value in watching the larger patterns, but to be completely honest myself, I seldomly hang around for after hours. If the market is really, really, really busy and there's a lot of stuff going on, I'll come back, but I'll go side note and I'll explain this. And I don't know that there are enough traders, generally speaking, that appreciate this point. When we sit down an hour and a half before the market opens, we've got X amount of energy. When the market actually opens, we've got less energy when the bell rings as we did an hour and a half before when we started. So our energy is depleting as the day goes on. This is simple stuff. I know that we all know this. But with trading, you always have to have the max amount of energy. You always have to be at max peak performance levels all the time. Mentally, you have to be razor sharp. Visually, you can't miss a fucking beat with this. So I like to get in the first move or second move, which is generally going to be in the first 30 minutes of the market, because that's where I'm most dialed in. That's where my biggest and best trades come from, because that's where I'm the most dialed in to the play. Now, having said that, when 10:30 comes along, 11:30, 12:30, 1:30, forget about it. I'm mentally shot. And so more often than not, you'll see that I put in a lot of work an hour and a half before the market opens and as much as an hour and a half into the market. But that's 3 hours of very, very concentrated peak performance energy that I'm putting to work. And in most cases after that, I'm completely wiped. So a lot of the energy that I'll probably burn 80% of my energy for the day in the first 4 hours of the day. Work, and then taking care of myself by going to the gym. Because you got to have another outlet. There's meditating, there's the gym, and there's work. There's those three things, and I eat well. And that's an energy kill. So a lot of the time when it's lunch in New York, I'm done. I'm toast. So I really like to get into the earlier moves, but it doesn't mean that bigger patterns don't produce themselves and play themselves out later on into the back end of the session. So you can wait for those things, or at least come back and see what's going on. CRTX, again, another primary example of a high probability pattern. So we've got that foundation pattern. We get a what's called a tweezer top candlestick pattern. We come back down right through here. Nice rounded bottom. This is actually what's called a cup and handle play. And you can see right through here that price action puts in an ascending triangle. Now a cup and handle is going to be, there's the cup right through there, and then the pullback, there's the handle. And what happens here is that you can see that MACD is signaling properly. We get a golden cross. We're above VWAP. We're above the 13. And then this thing goes supersonic and then double tops at about almost $4. This was a really nice play. If we go bottom of the gap and we measure where we would be getting in, right through here, you can see that it hit its levels perfectly. First level, pulls back, same pattern, squeezes again, moves up there, pulls back, tries it again, falls down. Double top right through here. I mean, to be completely honest, if I was in right through here at 208, I probably would have been out around 250, maybe 260, to be completely honest. I generally don't see this portion of the move. I get out early. Am I okay with that? Absolutely. All right. So I hope that some of this has helped. We're touching on the fact that we are in earnings season. This is, I mean, this is just, it's not a real term, but this is the time to be in super scalp mode. Reduce your expectations, reduce your profit target taking levels initially, and really, really load up on maximizing your risk threshold, or your threshold for risk rather. Tighten that up. Be really, really focused on managing risk first and foremost. We went over some of the pullbacks and the type of pullbacks and what to look for in a pullback. I hope that made sense. And we covered larger patterns over a longer time frame intraday. And I did a review on what I was trading today and what the general markets are doing. And that's pretty much what I got for Wednesday's Ask a Trader. So I hope that some of this has helped. If you have any questions, I'll be around for a few more hours. And that's a wrap. If I don't hear from you guys, I'll see you all tomorrow morning.